If you thought that fuel prices and shortages had reached their peak, we're sorry to break the news to you that the energy crisis is far from over and that the winter of 2022-2023 will go down in history as one of the most chaotic and challenging periods ever. According to official agents, the United States cannot produce enough supplies to meet the rising demand because our energy systems have been pushed to their breaking point. The U.S. Energy Information Administration recently released a new short-term energy outlook report, warning consumers and businesses that all energy prices, including those for oil, oil-based fuels, natural gas, coal, and electricity, have sent solar prices above their historical highs in 2023, citing geopolitical uncertainties and extremely low inventories as the main drivers of the calming spike. The International Energy Agency stated that there were still fuel shortages, particularly gasoline, on the horizon. According to an IEA press release from last week, the organization's members urged the government to act to address the nation's declining supplies of gas and diesel, and to get ready for widespread power outages. From diesel fuel for agriculture and freight to natural gas for electricity generation that powers our homes and businesses, U.S. producers will struggle to grow capacity, and it's a challenge we can't solve quickly. According to Bloomberg, even though refineries are now running nonstop and exports are at a record level, inventory levels are still below the seasonal average. In fact, according to economists, stockpiles are at their second lowest level for this time of year in more than 12 years. And despite an increase in energy costs, there are no signs of change. On the contrary, the most recent data suggests that American drivers will face greater financial hardship, and they partially confirm earlier year predictions. According to the chief strategic and investment firm, Garrigan Rosenweed, in the spring, it was predicted that American gas prices would catch up to those of other countries early in 2023. It was also stressed that the system as a whole was extremely vulnerable due to the concentration of much of the country's gas production in just a few plants, with Marcellus and Haynesville accounting for up to 40% of the total. Additionally, the Permian plant produced an additional 12% of the nation's total gas output. However, the rate count and the Permian have been declining for the past 2 weeks, according to the most recent data. Concurrently, electricity production is also impacted. The absence of alternate energy sources is a significant factor in that shortage. Coal facilities are being shut down. Droughts have affected hydroelectric capacity in several areas of the nation. A colder than anticipated winter could increase usage, and electricity grids are actually in danger of collapsing. Now, while this issue quietly develops at home, there is a continued high demand for energy supplies globally as everyone tries to stock up on fuels for this coming winter. The export of liquefied natural gas by American energy companies is at its all-time high, and domestic discontent is starting to emerge. The EIA urged the administration to ensure that there are sufficient energy sources for American consumers, effectively requesting that legislators limit the export of natural gas and petroleum. According to the organization, the price outlook for natural gas and oil-based fuels at the beginning of the healing season does not appear promising from the standpoint of consumers, but it is promising from the standpoint of investors. The reality is that American producers no longer prioritize maximization of output, but rather shareholder returns and profit over potential societal harm. The equilibrium of the American energy market is adversely affected by this. The Michigan Public Service Commission urged propane users to buy now to secure supply for the coming season of home remedying last Wednesday. According to the notification, consumers must be aware of their cost in advance because energy prices have increased significantly due to the ongoing effects of the COVID-19 pandemic and Russia's war in Ukraine. Propane is natural gas liquid and is carried through Enbridge Line 5 in the Straits of Mackinac, lowering the EIA forecast down to a local level. In the United States, the Upper Peninsula relies on Line 5 for more than 65% of its propane needs for hot water and heating. Propane is used in almost 50 million American homes, 5.8 million of which rely on it as their main source of health care. All once trustworthy alternative energy sources are currently experiencing their crisis. And the longer energy-driven inflation persists, the more we'll be forced to export our supply without building up domestic reserve. When compared to a few years ago when gas was affordable because it was plentiful, prices in the U.S. have increased by an outstanding 300%. According to oil price analyst Arina Slav, the kind of price increase has an impact on every link in the supply chain and has an impact on the entire economy. Sadly, politics rather than the restocking of stockpiles was what led to the decrease in gasoline prices that we had been waiting for after the $5 peak in June. Since oil prices will continue above $100 per barrel in 2023, Bank of America advised the public to take advantage of inexpensive gas while it lasts. According to the bank study, if interest rates continue to rise, the average price of a barrel may rise by 28. And analysts predicted that things won't start to get better until 2024, at the earliest due to the rising unpredictability and instability. At the end of the winter heating season, according to Michael Bradshaw, professor of global energy and the Warwick Business School, we'll have completely depleted inventories, making it even harder to fill that storage the following year. With any luck and effective policy implementation, we may make it through the winter. Supplies of heating oil and fuel are more than 50% below the recent norm in the Northeast, prompting worries that an extreme weather event might cause major disruptions in the upcoming weeks and months. According to a Department of Energy report, the fuels are 58 below the 5-year average from Maryland to New York and 63 below the norm in New England. Across the entire East Coast, gasoline stockpiles are still at their lowest points in almost a decade. In a global news interview with Patrick Dahan, head of petroleum research at GasBuddy, last week the agency claimed that refineries that are already struggling to meet demand currently lack the additional capacity to produce enough fuels to reduce demand. He claimed that although heating oil and diesel may be entering a more difficult period of the year, the Energy Intelligence Group issued an even more dire warning. The group emphasized that December 2022 to April 2023 will go down in history as Howe's winning period. The energy system is already at a breaking point. There's no extra capacity in the sector today. No rivers are flowing, and high temperatures are increasing the demand for power, which necessitates greater marginal natural gas use. Given that the capacity still exists and supplies are available, coal use has resumed. When possible, both large and small users want to convert to diesel or distillate, but refineries are only able to produce so much fuel. The repercussions of the surplus capacity policy's inability to handle this serious ailment could be devastating. Philip Furlake, an economist from MIT, was part of the group that included government interventions in energy markets on a scale not seen since 1945. Energy prices have been crippling American households for the entirety of a year. But a paper by the International Monetary Fund, according to economists, their financials will only get tighter in the months to come. Role of world's incremental fuel provider this winter, as explained by Lager. He estimates that the increase in gasoline costs will boost consumers' energy expenditure by 50% to between 7 and 10% of their income in 2023. Additionally, credit restrictions are influencing the energy market. For months, energy traders have asked central banks for extra liquidity, but the requests have been turned down. Currently, as prices rise once more, credit difficulties are beginning to resurface. The capital restrictions that restrict trader activity may also amplify the financial effect of a potential extreme weather catastrophe. As a result of increasing pricing, many consumers may be forced to choose between keeping their homes warm and putting food on their table this winter. What is currently taking place in the UK should serve as a stark wake-up call for American households. British residents noticed that the annual price cap for power and gas increased from roughly £100 to £1,300 to £4,300. That's $5,086. The UK could enter a catastrophic recession if this trend continues. With 20% or 1 in 4 households falling behind on their energy bills, many families in the nation face a real risk of being energy poor this winter. Shutoffs might affect millions of people just as they need a steady supply of energy. Contrary to Bradshaw's assertion, Felicia does not believe that political action will be able to address the limited supply of electricity, gas, and oil in the upcoming months. She asserts that although governments may continue to intervene in the market to distribute scarce supplies, given the track record of such initiatives, the impact of such actions on prices is unlikely to be significant. The chaotic market condition brought on by high energy prices over the next 6 months will likely cause some type of financial failure within the energy system, similar to how the subprime mortgage lending program led to collapse in 2008, he warned. According to the expert, the winter of 2022-2023 truly promises to be the one from hell, and unfortunately, we're all going to suffer from the drawbacks. If you enjoyed this video, subscribe to the channel, leave a comment, let us know what you think of the circumstance. Thanks for watching.